Hey everyone, Michael here. So in this video, I'm going to walk you through the Tesla company report and show you how I research a stock and how looking at the company report forms a part of my research process. So I've had Tesla on my watch list for quite a while, and basically I'm looking into it now today because there was news recently about the insider transactions that were occurring, and as you're probably already familiar with, that was referring to Elon Musk, the CEO, selling a whole bunch of shares. And on the surface, that might seem like a bad thing, like the founder selling shares. But the reason why is actually because he was exercising some options that were about to expire in early 2022. So I was reading this article here from one of the analysts at Simply Wall Street and basically just trying to get some context around how he's compensated and looking at why the sales were occurring now. And as you read through the article, it basically explains that yes, he announced that he was going to sell some shares as early as September 14 via something that's called a 10b5-1 form. And basically that's just like a rule that allows insiders within a company to announce at a particular date that they're going to sell a certain number of shares at a certain date in the future. And it's basically just to give people like sort of a heads up that they're going to sell in the future. It's much better than like just announcing a random sale, or not announcing, just filing for a random sale. It gives people a bit of context of like, okay, they've announced this in advance, they've given us some warning. And so some of the key takeaways to keep in mind, because obviously it might be concerning thinking the founder's selling stock. The article actually also shows that since December 2020, he's actually owned roughly like 170 million shares directly. Like he hasn't actually been reducing his holding. So these options that were about to expire in early 2022 form a large part of his compensation. So it's like he exercises the options, it gets issued a whole bunch of stock, and then in order to pay the tax bill, he's been selling some of those options to pay the tax bill, which as it turns out is roughly around like 53% of the gain that he's made, which is the price difference between 2021 and 2012. So this article here was giving me some context as to why the insider was selling, and basically was another reason for me to go and look at the company report and see if there was anything else occurring. So that's how I got started looking at the business. Basically why, like it's on my watch list, but that's like what spurred me to look at it again. So I'm just going to talk you through here what I see when I look at the company report and then what my next steps for researching it will be. So as I mentioned, it's already been on my watch list for a while, and I've been receiving updates about like companies' earnings and stuff like that. So I'm relatively familiar with the stock, but I'll still show you how I interpret the company report here. And so starting on the company report, the first thing I have a look at is the company Snowflake. And having a look here, I can see that it performs very well in regards to its future, past, and health, scoring 6 out of 6 for future and health, and then 5 out of 6 for the past. So the company has like a very solid balance sheet, has a really strong track record, and has incredible future prospects. That's just a very quick takeaway from what I can see there. And in regards to value and dividend, though, it doesn't perform well at all. So dividend, 0 out of 6, because I know that the company doesn't pay a dividend, and 0 out of 6 for valuation. This tells me that it seems to be like there's a lot of optimism baked into the price, and considering the price we might be paying today, it could be a bit expensive. So I'll get more context on that soon, and I'll explain to you how I interpret it in regards to future and value, because they're very, very related. So that was a quick takeaway. I already know what to look into when I get further into the report. So the next part I look at is the risks and rewards analysis. So first up, the rewards tell me that the earnings are forecast to grow like 34% per year for the next couple of years. So it's a very high growth company, as we all know. And also the fact that it scores 6 out of 6 in the future tells me it's got great future prospects. As for another reward, its earnings grew by 560% over the past year. So it's had a hugely successful past year. And now, while I don't expect that to occur or reoccur, it's still like great to see that it had such a great year over the past 12 months. And like the growth is expected to moderate, but it's still 34% per year is very high earnings growth. And the risks, it tells me there's been significant insider selling over the past 3 months. And since I was just reading that article about the fact that the CEO was exercising options and selling stock to pay the tax bill, that's understandable. And I have some context around that. And the shareholders have been diluted in the past year. So I want to have a look further down as to how much the shares outstanding have increased, how many more shares are out there. Because ultimately, as a shareholder, we own a slice of the pie, and if the company keeps issuing stock in the form of raising money via equity or issuing stock compensation to its employees, then we as shareholders ultimately own less of the pie. But if the size of that pie is growing at a rate faster than the rate of dilution, then that's not a huge issue. But if the company's not growing that quickly and shareholders are being diluted, that's a big concern. So I'll just have a look into that later on. But those are good things to tell me now to look into soon. The next part I look at is just basically the competitors. So this here provides me the snowflakes of a couple of the people that Tesla's competing against, the likes of Rivian, General Motors, Ford, and NIO. And already I can get a great overview of what these kind of businesses are like. So having a look at their snowflakes, I can see that Rivian, for example, has like a relatively solid balance sheet, but doesn't perform too well in its other respects. General Motors has an okay track record, okay valuation, not too good in terms of dividend, very poor health in that regard, and doesn't seem to have the best future prospects. Ford seems pretty mediocre in a few areas, and NIO seems to have good future prospects, an okay balance sheet, but not the best track record or value. So compared to Tesla, these companies don't seem that strong, but these, again, are something I'll look into further once I've finished researching Tesla itself. I'll then go and have a look at these competitors and see how they perform on their company report, and then I'll have a look at their qualitative aspects as well, like what products they're working on, specific type of models and vehicles they're working on, and try and get an idea of how they could fit in the industry, and if they've got any competitive advantage over the others that would make them successful in the future. Now, the next part I look at is the price history and performance. And just to be clear, I don't use share price movements as like an indication of whether I should buy or sell. Instead, I use this section basically to look at what developments have occurred in the company, because this section here shows me all the developments like dividend payments, which this company doesn't have, financial announcements, management, strategy, and other announcements from the company. And ultimately, what I want to look for here is like how these announcements have impacted the share price. So I'll go through basically the last 3 years and have a look at all these updates and try and get an understanding of what's been occurring in the underlying business. And then that'll help me build my thesis around the stock and get a better idea of what's actually occurring. So I'll go back all the way through to a couple of years ago as well, mainly because some of these projects that the business is working on are multi-year projects. And so they'll take quite a while to unravel and like actually start contributing to the bottom line. So I'll look for stuff that they started working on back here a couple of years ago and see if it's actually started contributing to the earnings about now. And then ultimately also I want to look at stuff here that's been occurring that's like new projects they're taking on, and that'll try and help me determine like, okay, if it's going to have the same sort of if it's going to have any benefit to the company's bottom line in the future. So I use this section basically just to get more qualitative aspects, qualitative understanding of the company, and like a bit more context about what's actually going on. And this next section is pretty much the exact same. So this is recent news and updates, and I use this section for the exact same reason. So this provides me with all these different updates and news pieces that provide context about the company. And there's articles from our internal analyst team, which I was showing you just before. And then we also have a partnership with Seeking Alpha where we provide some articles from them as well. And one thing I want to stress here is it's very important to read as many sides of the story as you can as possible. So say, for example, I'm bullish on a company just after a few pieces of news or insights that I've read about it. If I then go and read only everything that's bullish, then I'm going to be very biased, right? Like I'm not actually looking at the other side of the story, not even considering the negative aspects that some people are looking at. So therefore, my judgment isn't fully informed. So what I like to do and what I recommend doing is also reading those who have different opinions to you, right? So like, say you're incredibly bullish, read someone who's incredibly bearish. And in this case, this person thinks it's a ticking time bomb. They don't think it's the best stock, and they provide reasons as to why they think it's not. So what I'll go and do is like, yes, that's just someone's opinion, but it's like I'll go and read why they think that way. And then basically with all that information, like all the bullish aspects that I believe in or all the bearish aspects that they believe in for any stock, I can then go and look at all the potential like outcomes and then make my own informed decision of like, okay, yes, those are the reasons to be bearish, but I don't think they're that likely. Or I read these new bearish things and I'm like, okay, well, actually, I agree with you. I think they are very likely. Now I'm bearish on it. So basically reading all the different opinions out there and getting all the information as possible as to why to be bullish and why to be bearish can really help us make a more informed decision so that we're not just like having confirmation bias and just reading all the stuff that supports our original opinion. So that's what I use this section for, and it's also great to get the other updates that are like similar to what we were talking about before, like insiders selling stock and earnings updates and stuff like that. Just adds more context to the underlying, understanding the underlying business. Now, this next section here I use just to get a bit of context to how the companies perform versus the market industry. So I can see that Tesla has had a tear of a year, an incredible year, basically gaining 121% in the last 12 months. Compared to the US auto industry, it's done incredibly well. And the US auto industry has gained 77%, which is also huge, like amazing year for that industry. and that even outpaces the US market. So that 26% is nothing to turn your nose up at, but the US auto industry and Tesla itself have done even better. So while everyone's been optimistic in terms of the market, like a lot of businesses have increased in value, it seems like there's even more optimism baked into the US auto industry and Tesla itself. So I want to go and see if like this is justified optimism, and like if it's been increasing based on underlying earnings improvements, or if it's just a whole bunch of hype. So that's what I want to. That's like a bit of context there, but I want to go and find out more supporting evidence for it. And now the next bit here is basically tells you a bit about the company. I read this if it's a business that I've never looked at before, but I have looked at Tesla a few times. So I would read this section just to get an idea of what businesses it operates in and what kind of products and services it offers. So that's a great part to get a good summary of it. And speaking of summaries, this next part I read is the Tesla fundamentals. Basically, it provides me with the details like the market cap and the earnings and the revenue, and then it shows me some of the core metrics. So it's got a market cap of like 1.16 trillion. So I can see it's got revenue of 46 billion and earnings of 3.4 billion. So these metrics here give it a PE ratio of like 335, which is huge, and a price to sales ratio of 24. Now, one thing I'd like to quickly note is that a price to earnings ratio is only meaningful once you have a context about the future prospects, right? If I just look at a PE ratio by itself and I'm like, oh yeah, like 335 is huge, right? But if I have no idea what the future expected earnings growth rate is, then I can't really decide whether or not that's a high or low valuation, or high or low price to earnings multiple to pay. So what I'll look at soon, which I actually saw before in the risks as rewards area, was that earnings growth is expected to grow like 33% per year for the next couple of years. And now with that number in mind, 335 does seem like a very high price to earnings multiple to pay. So it may seem like it's a bit pricey at the moment, but I want to try and see if it's like too much optimism baked in the price, or if there's like people who are underestimating the amount of growth. And that's something that I can make from my own judgment by looking at the underlying business. And I'll get into that in a second. But this provides me a good summary of these kind of fundamentals of the business. And next part, this gives me a breakdown of the earnings and revenue. So what I want to look for here is basically, I want to see how gross margins and net profit margins kind of interact. So I can see here that to generate the $46 billion in revenue, the company has to spend $36 billion on the cost of generating that revenue. And that's stuff like the cost of building the cars and all those sort of inputs that go into actually generating the sales. And so there's $36 billion in terms of cost of revenue. So that gives it gross margins of about 23%. Now for an automaker, that's pretty standard, and that leaves it with a gross profit of about $10 billion. So considering how much input there has to be to go into the making of a car and then the selling of it, it's not the highest margin business, not like a software business. So I understand that it's got like relatively low gross margins, and that they would try and improve this by like increasing efficiencies, reducing costs, reaching scale, that kind of thing. So this is pretty standard for me, to be honest, at the moment. And then in terms of their expenses, they have $7.4 billion per year in expenses. And this is stuff like general and admin, sales and marketing, like if they do any advertising, and research and development. So, pardon me, after they've spent all that money, they then have $3.5 billion in earnings left over. And that gives them a net profit margin of 7.4%. So not the slimmest net profit margin, but it's not exactly huge. So I'd like to see, ultimately, as they continue to grow and develop, I'd like to see that these margins improve. And I expect that as they add sort of higher margin businesses like software sort of packages into their business, that these margins could ideally improve, right? Because they're not as capital intensive as the actual physical making of a car. So that's an interesting takeaway here. I can see their last report on September 30, and the debt to equity ratio is about 23%. So it's not that leveraged, which is great to see. They're not utilizing heaps of debt, which also helps explain why it has such a solid balance sheet. So that's a great summary there, and really insightful to learn. So I'll get more details on it soon. The next part I look at is the valuation section, and this, as we saw, passes 0 out of the 6 checks. And now that basically tells me, okay, this company might be overvalued at today's price. So as we saw, it's trading a PE multiple of 335, which is huge. So it seems like there's a lot of optimism baked in the price. Like there's very, very, very high expectations from investors. And I'll try and build my own opinion on it, and I'll show you how I do that now. So this model here is simply Wall Street's estimate of fair value. And now I know this is a model that has particular inputs, and I personally may want to alter or adjust some of the inputs. So to get more idea on it, I can view the data here, and I see that obviously it doesn't pass these metrics. Like, it's not trading below fair value, it's trading well above this estimate of fair value. And so I may differ in terms of what I think the inputs should be. So I can click view data here, and what I'll do is I'll just have a check of what the inputs are. So it's the average of the 33 analysts. That's how they got the forecast for the levered free cash flow. The discount rate was 8.7%, and the perpetual growth rate was 2%. So first up, I may disagree with some of those, right? Like, if I was to go and create my own Excel spreadsheet, like after this video, and I try and do the same discounted cash flow, but I use different inputs, I could get a very different estimate of fair value, right? Which is what some investors might be. They may have different inputs here, which is why they think the current price is fair, or they may think it's not even fair and undervalued. So if I was to increase this perpetual growth rate to like 3%, 4%, 5%, that would have a big impact on the estimated fair value. And same thing here, if I was to decrease the discount rate to like 5%, that would have a big impact on the fair value as well in terms of increasing it. So that's something to keep in mind. And also, one thing I want to stress is it's very of the business like Tesla, its expectations, especially since it's in like the electric vehicle space. There's a wide variety of different estimates for how well this company is going to do, and also how big the EV space is going to be. So I can see that like the analysts have provided estimates out to 2025, and this is the average of their levered free cash flow estimates. And then the model going forward is basically just an extrapolation of those past growth rates. And so basically I can see that they reduced like 15, 11, 8, 6, 5, 4. And I may think personally that like, wow, okay, well by the year 2031, I actually think it's going to have way higher free cash flow because of how big the EV space is going to be. And let's say I think Tesla's going to be very successful in that space. I may think that these growth rates are underestimated, right? So I may think that it's actually going to be growing much higher. Therefore, I think its fair value is like higher than what I think this model shows. So I just want to stress that like the fair value I'm seeing here is based off these numbers, and I come in and look at it and I go, okay, I see how it's got them, but I'm going to go and create my own model and forecast with different growth rates because I think it's going to experience higher growth. Alternatively, it could be the opposite, right? Like I may think, oh, no, Tesla's not going to do that well. There's some other businesses out there that might steal their market share for whatever reason. I may think it's going to grow not as quickly, and therefore that may support the thesis of like, oh, I think the stock's overvalued. So just wanted to delve into that and show how I view that sort of fair value estimate, and then what I do personally to add my own inputs to it. And to get my own inputs, basically, I would do the more qualitative research. So like I mentioned above with the news and updates, I'll go and look at the underlying business. I'll go and look at the new products they're developing, like how they're increasing their cost efficiencies, how they're planning to grow, what new products they want to release, markets they want to enter, stuff like that. To then be like, okay, I think this growth rate is reasonable, considering I think these things they're working on are likely to be successful or to have like a good outcome. So that's how I can get some context for what growth rates I think are likely. And so yeah, according to that model though, basically it just says it's overvalued, and I understand why it thinks it's overvalued, but I'll then go off and do my own estimate of fair value based on my inputs once I get some more qualitative aspects on it. And now this next section here shows me basically a snapshot of like the investor optimism that they're expecting in the price right now. So this shows me the PE ratio compared to the market and industry that's in, the industry being the auto industry. And so according to this, it's poor value because it has a PE ratio of 335 compared to the industry or US auto industry of like 27. So hugely overvalued compared to them. And compared to the market as well, it's also very, very overvalued. So I'll want to have a look at the future section coming up and just see if its growth rates differ from these two sections and if the price is therefore justified based on how much growth it's expected to have. And this price to earnings growth ratio basically tries to use the price to earnings multiple as well as the expected growth rate just to try and account for the expected growth rate. It's not too meaningful to me, but according to this, it's also poor value. And the price to book ratio, basically, I only use this if it's like I'm looking at industrial or financial stock because they generate a lot of their income or profits off their like asset base or their book value. And so I basically won't use that here in this case because it's not too meaningful to me. So the next part I'm going to have a look at is the future growth section, and this tells me it's got incredibly good future prospects. It passes all 6 of the metrics. So that seems to support why it's trading at such a high multiple because it's such a high growth company. So according to analysts, it's expected to have a 33.9% earnings growth over the next couple of years. And this chart here basically just shows me that a visual representation of their average of their estimates. So this here, what I'm looking for is basically if everything is like they expect, trending up and to the right. So it looks like they're expected to have a lot of top line growth. Like their revenue is expected to grow really quickly from 46 billion this year to 91 billion by the basically in the next 2 years. So huge growth, almost doubling. And similar with earnings and free cash flow and cash flow from operations, they're all trending up and to the right as well. So that's why people are so optimistic on the stock, because they think it is continuing to grow quite quickly. Now, what I want to take away from here is basically like, is this data reflective of or supporting the high expectations in the price? So say it was trading at 335, and these forecasts for the future earnings and revenue weren't trending up and to the right, like for huge growth. It's like, well, that high P then might be unjustified, right? Like it's not actually expected to have that much earnings growth, so it shouldn't be trading that high. But in this case, like it does have earnings growth, but I just wonder if this 34% per year is enough to justify a P/E ratio of 335, because that just seems way out of whack. So there's like a lot of optimism baked in the price. I'll just keep that in mind when I'm looking at the stock. Now, the next section I look at here is what I was talking about, where I just want to compare it to the industry and market, which is to see if that high P is kind of like justified. And it seems like it may not be. Like Tesla is a huge business, and it seems to be the most successful EV company at the moment. And so because it's so big and it's already generating so much in revenue compared to other players, it's actually like relatively similar in terms of its earnings and annual earnings and revenue growth. So 34% versus 35%, 23% versus 28% in terms of revenue growth. So this shows me that if I actually want to look for a company that's even higher earnings growth, expected earnings growth, there might be different players in the auto industry that I should actually look at that might have higher earnings growth. But I mean, it's very similar, so it seems like they're on par. But by looking at the PE ratio we saw before being 27 for the industry versus 335, it tells me that there might be better value opportunities out there if I'm looking for a fairer price to pay, where I may find an industry that has, a stock in this industry that may have the same sort of earnings growth, but a more reasonable price to earnings multiple. So if I'm looking for more of a value play, then I may go and look at alternative stocks out there, but that just gives me a bit of comparison. So there's a lot of optimism baked into this stock in particular compared to the industry. And as for the market, it seems like it doesn't have anywhere near as much revenue or earnings growth. So this is a high growth industry. Like there's lower growth industries out there in the market, but if I'm looking for high growth, it seems like I'm in the right spot. And so as I mentioned, it passes all these checks, the minimum of just passing the savings rate and everything else here as well. The next part I look at here is the earnings per share growth forecast. And basically, I want to get a bit of context for how varying the estimations are of what the company could be earning in the next couple of years. So just to give you some context, this blue line here is the actual company's reported earnings per share for the trailing 12 months for these periods. And the blue shaded area is the analyst estimates, like highest to lowest for these periods as well. And they basically give you some context for like how optimistic or pessimistic people are or analysts are. And going forward, this teal blue line is the expectations of the average of analyst estimates for EPS, and the shaded teal area is the range of estimates, right? So the top one here is like $12.84, the most optimistic analyst, and down here is the most pessimistic or least optimistic, because they still expect growth, of like $5.62. So I can see that there is a wide range of estimates, right? Like some analysts expect huge growth and other analysts expect not that much growth. So what I want to come back to here is like when I go and do my research, and like I said, I go and look at these qualitative aspects of the business and try and understand like what projects they're working on and how much earnings growth they might have from the projects they're working on. I'll then come back here and I can try and see which price I think is more fair, right? So let's say, for example, I think the projects they're working on are going to generate a lot of earnings growth, and that I actually then agree with this $12.84 based on what I've looked at. And I'm like, yeah, I think the bottom line is going to grow incredibly quickly. It's going to go from the $3.57 today to $12.84 within the next 2 years and beyond. I agree with this. Then I think, oh, well, today's price might actually be a bit fairer. Like it might be more reasonable because I have such high expectations of growth, like even higher than 33% per year for the next couple of years. I have even higher expectations. Therefore, I think the higher price is actually a bit more reasonable. Let's say I look at those. Alternatively, let's say I look at those exact same projects they're working on and I think, nah, they're not going to contribute that much to the bottom line. It's not going to be as profitable as everyone thinks it is. And I'm more like pessimistic and I've got more estimates more down here or even lower. then that would reinforce the fact that I think today's price is very expensive, right? Because I don't think it's going to have as much growth as everyone else thinks it does. So that's what I would do here. Like I go and look at the qualitative aspects and the underlying business and come back here, and then I can make my own judgment on what I think is more likely to happen. So that's how I use this section, and it's hard to provide context yet until I look in these aspects of the business. But I come back here and I try and then run my models and be like, okay, if I thought that was right, is today's price a fair price? Or if I thought this outcome of like EPS was more right, is today's price fair? So that's how I use this section of the report. And the next part I look at is the future return on equity. So I just want to see how profitably the company is expected to allocate its shareholders' equity in the next couple of years. And this is based on the analyst estimates, who estimate what it's going to be in 3 years' time. And they expect it to actually outperform the industry and generate returns on equity of like 27%. So anything over 20 is really good, and it's really encouraging to see that not only is it above 20%, but it's above the industry, which is expected to be about 22%. So it's expected to have profitable initiatives to invest its shareholders' equity in at good rates of return. And as a shareholder, that's great to see, because you kind of want to see that. Considering this company isn't paying a dividend, it's good to see that they're like reinvesting in highly profitable sort of initiatives, or they are expected to be able to reinvest in highly profitable initiatives. So that's good to see. And the next part I look at is just past performance. I just want to get an idea of like the track record of the company and see if it's actually got like a proven business model and a proven track record of performance. And it looks like Tesla has, right? It passes all the checks bar one. So it's had 56% annual earnings growth over the last couple of years, so that's great to see. Although it was loss-making a couple of years ago, so that can be kind of like hard to calculate correctly. So what I can see here is just the top line growth has just been huge, right? So it had a revenue of $3 billion back in March of 2015, and now it's $46 billion. So their sales are going like compounding incredibly quickly, and they've got heaps of top line growth. And they've been reinvesting in the business like crazy. So now they're actually finally generating a profit down here, and I can see that it's only been the last year pretty much. One thing I want to keep an eye on though is the free cash flow and cash flow from operations. Basically, these cash flow from operations tells me the cash flow from the core business, and the free cash flow, as I mentioned in other videos, is like cash profits versus accounting profits. Accounting profits is the earnings on the income statement, net income, whereas cash profits is like what you see as free cash flow from the cash flow statement. And it's good to see that they're roughly in line here, 3.4 billion and 2.56 billion, roughly similar, but they're roughly both trending in the same direction. And same thing with cash flow from operations is also trending in the right direction. So it's cash from its core business is improving, which is good to see. And the last part I look for here is the operating expenses. So basically how much the business has to spend to operate. And it's good to see that that's been relatively flat over the last couple of years, from like 2.6 billion to 6.3. I say flat. Comparatively speaking to revenue, it's been flat. So it's good to see that they haven't had to increase operating expenses incredibly quickly in line with revenue. They've actually been able to increase revenue in spite of not actually increasing their operating expenses too significantly. So that's good to see that like as they're reaching scale and continuing to increase their top line, they're not having to increase their operating expenses at the same rate, which is good to see. Now, it's also another thing, it's good to see high quality earnings, so it doesn't have any huge one-off expenses that have incurred that have hurt the earnings temporarily, and it's got good free cash flow conversion, or like I mentioned, that accounting profits versus cash profits. It's got they're roughly in line, which is good to see, and its net profit margins have been improving. Another huge bonus. Now, this next part here just shows me more of the track record. Basically, how has the company performed compared to its industry and market, just like in that future section, and it has hit it out of the park. So huge earnings growth over the past 5 years compared to the industry, which has only had 3.3% of the last couple of years, compared to the market, which had 13.2%. So it outperforms there. And in regards to the last year of earnings growth, it's grown incredibly quickly. So it's got accelerating earnings growth, which is like basically showing me its trend is improving even more so as of late. Where it had 560% earnings growth versus the industry, which had 240%, which is still huge, versus the market, which had 41%, which is still nothing to turn your nose up at. So huge performance compared to even like really good performance from the market industry itself. So just a standout performer in that sense. So it shows me like it's a really strong performer, even compared to good performance from other players. So that's great to see here. Now, the next part I look at is these profitability metrics, basically return on equity, return on assets, and return on capital employed. What I want to look for here is like how well they're allocating the shareholders' money or debt as well at the moment. That other one above was the future, how well they're expected to do in the future, but this one is now. And it's actually pretty low at the moment. So Tesla's return on equity is actually 12.6% at the moment, and compared to the industry of 22.4%, it underperforms. Now, I provided a bit of context here because it's expected to improve in the future. So while they're not generating that much of a return right now, it's telling me that they're expected to do so in the future, where it's like 27%. So although this is low and it's kind of disappointing to see that it's not as high as the industry, it's expected to improve. So I've got a bit of context there. And these next parts, return on assets and return on capital employed, most meaningful one is probably return on capital employed. Basically, return on assets is like just showing me like if it's an asset-intensive business, how much of a profit is it generating off its asset base. And in this case, it's like it's okay. It's over 6%, 6.8, but it's not as good as the industry. It's like underperforming in that respect. So it's not using its assets as efficiently. But that metric there isn't too meaningful to me, just basically because it's not like heavily reliant on its asset base to generate a profit. Whereas the return on capital employed basically just shows me how well it's allocating shareholders' money and also debt as well. So it's basically total assets minus current liabilities. It just shows me how well it's allocating all sources of funds. And it's been improving, which is great to see. So 3 years ago, it was like loss-making, generating negative 6.3%. But last year, it was actually 11.5%. So while it's not the best return, it's improving. And if that trend continues, I'd like to think that in 3 years' time, that could surpass like 20% and show that it's still able to invest in profitable initiatives. So good to see that it has a great track record. Now, this next section I look at is the financial health. And just to see basically, is there any risk of bankruptcy? Like if the company has debt, is there any risk of bankruptcy? And if it does have any debt, like is it affordable? So having a look at this, it passes 6 out of the 6. So according to Simply Wall Street's metrics, it doesn't seem to be at risk of it at all. And the first thing I look for is basically just does the short-term assets, and this is the metrics we check too, does the short-term assets cover the short-term liabilities? And does the short-term assets cover the long-term liabilities? So stuff like cash and cash equivalents here, can they pay their short-term liabilities? Anything that's due within 12 months, like accounts payable and stuff like that. And it looks like they can easily with the cash and short-term assets they have on hand. And can they pay their long-term assets, which is stuff usually like longer-term agreements, anything over 12 months that is like a liability. And it looks like they can too with their 25 billion here. They could easily pay it as well. So in terms of like a cash buffer, it seems very solid, like they can pay all their obligations in those respects. Now this debt to equity history analysis, I use this just to see how the company has been utilizing debt to run its business. And so what I do here is I overlay the cash and equivalents, and I just want to see what the trend has been of all three of these. So the company didn't utilize that much debt back in 2015, but it's actually increased quite a bit up until like mid-2020, where it reached about $12 billion, but not too much in respect to how big the company was. But it actually has been reducing its debt over the last couple of years, and it's down to like 6.67 billion now. So good to see that they've been like reducing the amount of leverage and actually increasing the amount of equity that they're using to fund their operations. So I think they did some capital raises around here, which is why the cash improved so much and so significantly in this short period. I'll have to double check that. You guys can probably confirm for me. Pretty sure they did some capital raises here via equity. So they issued some new shares, and this also helps explain why the equity has improved so much. So this is also through stuff like retained earnings. But yeah, just the general growth in the share price has basically changed the capital structure of this business. So these checks here show me that, oh, it actually has its debt level, like it's really, really manageable because it has more cash, like 16 billion versus debt of 6 billion. So if it wanted to, it could use all of its cash it has right now to pay off the debt that it has. And that's great to see. And in regards to the debt to equity ratio, it's decreased significantly, like I said, paying off its debt, which is great to see. And the debt that it does have, let's say it doesn't even choose to use the cash to pay it off, it's got operating cash flow and EBIT that can easily cover the debt repayments. So the operating cash flow, which is that stuff we saw with the cash flow from the core business, it could easily pay it off in 1 year because it has 148% coverage. And the earnings before interest and taxes can easily cover the interest payments that are needed to be paid to service the debt. So in terms of its financial leverage, it seems very conservative, and it's got like a really solid balance sheet, which is why it passes 6 out of the 6 checks. So great to see. And this last part here just gives me a visual representation of the balance sheet itself. And as you guys know, with balance sheets, it's like a double entry system. So everything that's on the asset side has to be accounted for on the liabilities or equity side. And this just gives me a breakdown of all the assets. Again, the key thing that I kind of look for is obviously similar to the above. Cash can cover the debt. And also I just have a look at like the accounts receivable and accounts payable. So they're due to receive like $2 billion like from accounts that owe them. but they have to pay out 8.3 billion in terms of their accounts payable, and that could be stuff like suppliers and stuff. So in this respect, it actually has quite a bit more in terms of its accounts payable, but it does have plenty of cash on hand, so it seems like it could easily pay it, which is good to see. Now, the next step I look at is usually the dividend, but as we mentioned, Tesla doesn't pay a dividend, so I'm not going to research this section, but I just want to stress that because Tesla is such a high growth company and has such like a big opportunity in the electric vehicle space, as a shareholder, it makes sense that they're going to reinvest in the business rather than pay a dividend, right? Like, I wouldn't want to receive a dividend because the opportunity in front of them is so big. As the management team, they have a decision. Do we reinvest in the business, or do we like return money to shareholders in the form of buybacks and dividends? And it's like, well, they've got so much opportunity in the EV space, and they like really need to build up their competitive advantage and reach scale and just reinvest so much in the business. And it seems like they're already starting to see some good returns, and they're expected to even improve in the future, as we saw the return on equity. I, as a shareholder, am like, yeah, don't return the money to me. I can't find that good at reinvestment opportunities myself. So please reinvest in the business, and please try and grow the business so that in 5, 10, however many years' time, when the business has reached scale and reached that point of a business where it's like, okay, we don't have as many high growth reinvestment opportunities, we can start to return money to shareholders. If I invest now and we get to that stage in 10 years' time where it's reached that stage, the dividend that it could pay would be huge, could be huge compared to what the price I paid right now. So that's just something to keep in mind. If a company doesn't pay a dividend, it won't pass any of these checks, but that doesn't necessarily mean it's a bad thing, right? So just keep that in mind when you look at these kind of stocks. So I'll skip through here. And the next part I look at is basically management. So I want to know how long they've been there, like who's basically running the company, and also are they aligned with shareholders. So the average tenure of management is about 2.7 years. That's pretty good. It tells me that there isn't really much of a high turnover, like everyone stays there for a couple of years. If I saw anything less than 1 year, I'd be concerned because it's like just means people are coming in and leaving really quickly. And the CEO, so as we know, it's Elon Musk. He's been there for 13 years. And if I wanted to know a bit more about him, I could read this section here and get to know all of the stuff that he's worked on throughout his career. So get a bit more context on him. The next part I look at is the CEO compensation. Basically, I want to see that he's been compensated in alignment with company performance. And from looking at this, it seems like he doesn't receive much of a salary, if at all. And his compensation does seem to be in the form of stock options. And thanks to that article I was just reading, it seems like it's primarily his only form of compensation. And until they report their next annual report, we won't have this latest data here. But we can see that in regards to the company's earnings, they've been improving significantly. And so the fact that he's just exercised a whole bunch of options to sell some and then sold some shares to pay for some tax bill, it makes sense that I think his compensation is going to be just as high, if not more so, over here. So that'll be something I look into once the annual report has come out. Now, the next part I said, I just look at the the leadership team, and just look at how much they own of the stock. So what I'll do is I'll read through these profiles of each of the individuals who are actually in the management team, and just to get a bit of idea of their history. And then I also just want to have a look at their tenure, how long they've been there, their compensation, how much they receive in like total compensation, and then also just how aligned they are with shareholders, like how much skin in the game they have. And so from the ones that have data, I can see that they've got millions of dollars invested, which is great to see, right? So like they are aligned with shareholders in the sense that if they make decisions that benefit shareholders, it benefits themselves, which is really good to see, because ultimately that's the kind of thing I want to see occurring, because if they're shareholders as well, then they will benefit alongside me as if they're investing in it as well. So for the ones that have data, it's great to see that they're really highly aligned. And for those that with no data, they may have holdings that are in like entities and trusts that are really hard to kind of find data on. So while I won't take this at face value where they have no holdings, they may have external holdings that aren't in their individual name. So that's just something to keep in mind. And as I mentioned, the tenure is pretty good, and they seem really, according to that, they're relatively experienced, which is good to see. Same thing with the board members. That's the exact same sort of check I do. I read through the client profiles and see the profiles and just see what they've done, look through their tenures, and look through their compensation as well. So it looks like they've all been there for at least a couple of years, 1.5 there, but they all have some relatively long board experience. And in regards to their ownership, it seems like they're all very aligned in the sense that they've all got millions of dollars invested, except for this person here. They've all got skin in the game, which is good to see, right? If shareholders benefit, they benefit. Therefore, as a shareholder myself, they are incentivized to make the right decision for shareholders because they are one themselves. So that's really good to see. And their tenure is even longer, 3.7 years. So that's good, meaning that they have like experience running the business. And considering the last 4 years have been really good, it's good to see that they were the ones who were at the helm while it's done that. Now, the next section I look at is the ownership section, and this is just basically a breakdown of who the biggest shareholders are and who's been buying or selling. So, as I mentioned, the reason I was looking at this company again is because of the recent sales that were occurring from Elon Musk, the CEO, and this is a breakdown of those particular sales. So we can see from this here that the shares sold over the last 3 months have been like 5.7 billion, and they're primarily attributable to him, and I'll get more details on this later in a sec. But this section I use basically just to see if there's any large overarching trend of either buying or selling from multiple insiders, right? So if I see multiple sales occurring from multiple different insiders for large amounts of stock, that would be concerning, right? Because I'm like, oh wow, they're really like offloading a lot of stock. Why are they all offloading their stock? So that's something I would want to look into. Alternatively, if it's on the opposite side, where there's lots of insiders buying lots of stock compared to their current holdings, then I'd be like, okay, wow, lots of insiders seem really bullish. Maybe I should look into this further myself. So in this case, I can't really see any overarching trend, and there just seems to be this one particular large sale recently thanks to these options. So nothing too concerning that I see here, but yeah, as it doesn't pass that check because there has been insider selling. And so this just gives me more details here. There's the most recent sales that have been filed by Elon, particularly a couple $2 billion. I think there may have been more recently that haven't been released yet, and some selling from Kimball as well. And so this just gives me some more details on the insider sales, but I'm not too concerned, as I mentioned, because I didn't see any large overarching trend. And now this ownership breakdown, I just look at it to see who's got the most say in regards to the company, and it looks like institutions have like just under half of the say when it comes to votes at like the AGM. General public has like just over a third, and individual insiders have like 18%, mainly made up of the CEO, Elon Musk, and these other entities have tiny amounts. So that dilution I was talking about, though, is the thing that has been occurring. So this risk tells me that shareholders have been diluted in the past year with, total shares outstanding growing by 6.2%. So that is concerning, like I said, because there's now more slices of the pie and you technically as a shareholder own less of the pie. But if the pie itself has been growing much, much quicker than that 6.2% dilution, it's not the biggest concern, right? So with this, I'll basically want to go and look at the compensation packages they use for their staff and see if it's like excessively reliant on equity compensation, because then I might be a bit concerned where the amount of growth for the company is huge, but my shareholding is being diluted at like a relatively high rate. So I'm going to go have a look at that in the annual report. And also, I just want to check like if they are likely to raise equity again, like they did, I think, in 2020, to fund their projects. Because if they do that again, that's like a big chunk of a way to dilute shareholders as well. So if I think they're going to keep doing that rather than using debt, then that's another concern where I could be diluted even further. So that's something I'll look into further. And this next part is the top shareholders. And again, it just shows me the breakdown of all those ownership groups that we saw above. And as we saw, Elon's the biggest shareholder. And these are the institutions lower down and some individuals as well. What I look for here is basically just if there's been any big change. So even though he's been selling billions of dollars worth of stock, I can see that this change actually isn't that large in relation to his total holding. So that's why I'm not too concerned, right? It hasn't been a huge offloading of stock. He's actually just been exercising options that he's just been issued. And he's now selling some of them to pay for a tax bill. So I'm not too concerned because it's not a huge part of his holding, and he doesn't seem to actually be selling some of the existing holding until some other sales that are occurring. So what I look for here, like I mentioned, is just any large overarching trend. So this institution here has been offloading quite a bit of stock. I may want to look into why, but I want to look for, just like that ownership section above, I want to look for large trends. So if there's been any, like if I saw all of these institutions were offloading their stock, I'd be like, okay, wow, there's a big lot of selling. Why? And I'll look into that further. Alternatively, if there's a whole bunch of them loading up on stock, like buying more, which it seems like they're modestly increasing their positions in the stock, I'll want to look at why as well. But because some of these are like big institutions that have like index funds and stuff like that, some of them can just be generally because they have more funds flowing in, and so people naturally they then buy more stock because it's in the index. So that's something to keep in mind. But basically, like I said, I just want to look for if there's any large trends, because then that's something that's like kind of grabs my attention. But in this case, nothing too concerning to look into. So that's pretty much how I read the whole company report. And so the next steps of what I would do from here is, like I said, go and get more qualitative aspects and understanding of the company, like what projects they're working on, what markets they're entering, and how all their current work is unfolding, by reading through those recent news and updates, try and get some bullish opinions, bearish opinions to help get myself a more informed decision. And I'll look into that equity compensation package as well, just to see if they're too heavily reliant on it, because that's something that could be pretty concerning. So just before I finish up though, I just want to show you where you can find some more details on those filings from the sales that people have done. So the insiders, right? If you want to find more details and actually find out why people have been selling, you can go to a company's investor relations section. And so this is the Tesla investor relations section right here. And you can see here that this is the SEC filing section. And you can look at these statement of changes of beneficial ownership of securities. Now, this is obviously US based. There's different for different countries. But what I've got here is I wanted to look at some of the actual trades that were occurring. And they actually tell you, they actually provide a lot of insight into the actual trades that have occurred. So this is what's called a Form 4. And basically, it's a lot of information here and there's a lot of tech here, but I want to share some of the key things you can look for, right? So this is the thing that's submitted whenever there's an insider who's providing a filing that they're selling some stock. So you can see some details here, like the person, there's the stock and everything like that. And then here's details of the actual trade. So you can see that they acquired 2.113 million shares at $6.24. That was the exercise price. And then the D means disposed, and they disposed of this many different shares at these different prices. So huge discrepancy between the price he paid and the price he sold at, which explains why there's such a large tax bill. And this section here is what I want to stress. So the explanation of responses basically provides context as to what the selling was. So let's have a look at this. The transactions reported on this Form 4 were automatically effected pursuant to Rule 10b5-1 trading plan, previously adopted on September 14, 2021, and established by the reporting person for the purpose of an orderly sale of shares related to the exercise of options scheduled to expire in 2022. So that tells us the answer, right? Like these sales occurred where he already had them announced or planned at a predetermined date, being September 14. He said, yeah, I'm going to sell some shares in the future at a predetermined date. And it's because I've got these options that are going to expire in early 2022, so I have to exercise them now. And the next part is the shares of common stock were sold solely to satisfy the reporting person's tax withholding obligations related to the exercise of stock options to purchase of the 113 million shares as reported herein. And then the next is just some details about like the price paid in specifics and shares sold. So these Form 4s can provide a lot of context about why these insiders have been selling. So you can see here that all of a sudden you see, oh, okay, it's because he had options that were about to expire. I shouldn't be too worried because it's not like he was selling his existing holding. And it can provide some real context like that. So the key things I would say to look for is if you want to get more details on individual insiders selling, have a look at the company's investor relations, SEC filings, look for the changes of beneficial ownership, look for the details of the person you're looking into, have a look at how much they've acquired and disposed, and then also just read these explanations of the responses, and this gives you a lot of context to understand why the person was selling. So yeah, that's pretty much how I research a stock in the company report and get a lot of context on it, and I just want to show you the little bit of additional insight there as well. But yeah, those are the next things I'll look into, the equity compensation and the company's underlying projects. And as I've got the stock on my watch list, I'll keep getting notified of like key updates that are occurring, like earnings updates and more insider transactions and stuff like that. So yeah, I hope that video has been helpful, and thank you so much for watching, and I'll see you next time.